Welcome back, everyone, to Vox Markets. My name is Paul Hill, and I'm delighted again to be able to speak to Tim Sykes, CEO of Proactis, a leading developer of business spend management software. So welcome, Tim.
Hi, Paul. How are you doing?
Very good, yeah. Big congrats on this morning's resilient trading update. But before we sort of dig into the details, can you just give us a top-level bird's-eye view of how the business has fared over the past sort of like 6 months, and also into the third lockdowns, and how it views the sort of 2021, the sort of calendar year 2021?
Yeah, well, I mean, I think we've done really well on the basis that we entered second and then third lockdown in the half year, which we weren't expecting coming into the financial year. So I think we've done really well to continue the progress that we have. We're certainly being affected. New business is out by, we'd say, 15 to 20%. We've seen deferrals of decisions of about 2 million of TCV, something of that kind of order. So that's on specifics.
Yeah.
So absolutely it's affecting us on new business and on revenues, just the volumes are still suppressed on our volume related contracts. So yeah, it's affecting us, but all we're doing to match that is to offset with costs and investment progress. So we're able to continue with our forecasts on profitability, and we've actually increased the margins half year on half year. So we're as strong as we could be in the circumstances, and looking forward to coming out of lockdown now and moving forward with the economy and really exploiting the chances that we've got.
And some of those deferred orders, presumably they're not lost, and they're sort of opportunities again for the second half, I guess.
That's right. I mean, they're deferred. So we're preferred vendor, deferred basically from logistical capability to deliver. So they're not entering into the contract until they're ready to go on the project. And that's affected the outturn. So of our sort of just shy of 7 million TCV, that could easily have been at high 8-9 million perhaps without second and third lockdown.
Yeah. So effectively what we're saying then for 2021 calendar year, it's going to be a game of two halves, sort of like getting through the first half, and then the second half should really sort of like storm higher.
We always knew that because of the strategic plan, that second half was going to be better than first half. It always should have been that way. As we build pipeline in France, Germany, and the US, it was bound to be that way. Hopefully, I mean, it'll move forward. But the real game is FY22 and calendar 22 in reality.
And then just on that, on the strategy, what's sort of the progress on the strategy? Because obviously you've got brilliant business models in the UK and the Netherlands, and now they're sort of like the learning, the sort of like the secret sauce seems to be transferring to France, Germany, and the States after some breakthrough contracts.
Yeah, that's the plan. I mean, the plan always was, if we go back 18 months, when we adjusted the strategy to go into the mid-sized organisation single segment strategy, we said it'd take some time to build the teams up and the methodologies and the business processes in order to be able to execute. It has gone slower than we wanted because of COVID, but ultimately we're doing it now. So we've got the proof points that our single platform multi-tenanted solution sells into that mid segment in each of France, Germany, and the US. We built pipeline in behind that as well, which is slower to come through COVID, but it's still pipeline that's there and coming through. So it's now about building momentum to the levels that we want to do. And our ultimate objective here is to be able to create the same value of TCV from France, Germany, and the US as we presently get from the UK. The economies and the opportunities are obviously as the same, if not larger. So great chances to replicate. Timing is sluggish essentially because of, slower than we wanted, let's say, because of COVID, but it's happening and we're on our way.
And what's the TVV? Just remind us in the UK.
So total contract value. So
how much is it?
In the UK, we sell regularly 8 to 10 million of TCV a year.
Right.
And that's what we expect to sell ultimately in each of France, Germany, and the US, if the market opportunity is the same, which of course we think it is.
And then just sort of like allowing investors to sort of translate that into sort of top line growth, etc. So if you do total contract value of, let's say, hypothetically, if you replicate that model and you do, I don't know, 30 odd million of TCV annually, etc. How does that translate into the top line sales?
It's double digit growth, yeah. Certainly north of 10, probably close to 15% organic growth in that. Because if you think about it, simplistically, think of us as an aeroplane with 5 jet engines, but only two of them are firing at the minute.
Yeah.
we've got to build up to 5, and it's a straightforward addition and an aggregation of what we can do. I think it's 35 to 45 million of TCV is our target over the next 18 to 24 months.
Yeah, okay.
To do that, we'll be growing at something like 8 to 10 million net ARR a year.
And so essentially what we're saying then, I mean, if you've got recurring revenue streams, which is what, I don't know, they're sort of like 80% of your total sales, but I think ARR in June last year was about 40 mil. So we're talking of sort of like ultimately, you know, well, is I say adding at least another, if you say another 8 million each year, but essentially what you're getting presumably is that the ones you signed 4 years ago, they're also sort of like hopefully becoming recurring revenue streams. So they'll become additive, won't they?
That's right. And if you look at the churn numbers, we're down now at a run rate of about 2 million of churn per year, which is normalised. So if we take out of the heightened risk accounts that we identified at the end of FY19 to show the overall risk or exposure to the historic problems that we've had, those are working their way through and out now. And we're back at a normalised level, which is about 2 million per annum of churn.
Yeah. And then just on the actual sales in the first half, so you had, I mean, basically you increased your EBITDA, so congrats, I mean, led by 11%, presumably by some sort of laser focus on the costs. And you sort of like only had in the first half, a 3% decrease on the actual sales. How does that sort of like, you know, pan through? I'm guessing you mainly hit on the transactional side, was it, on the supplier side in the first half?
Well, the first element is the full year effect of the HRA accounts that were lost in the previous year.
Yeah.
So that took net ARR down, which has impacted revenues. Then we've got push out still on volume-related contracts, which are lower across the piece, and then push out of services-based revenues because of projects that have been deferred because customers can't get to them on their prioritised list, you know, through the course of the first year. So it's those 3 areas that are impacting revenues and have taken it south. But you're absolutely right. I mean, what every conservative company that is sensible is looking at their cost base, and we've also done that, and that's right-sizing ourselves for the future in reality, and getting ourselves into that operating cost base that's highly leverageable for for an uptick.
And that pent-up demand, though, I mean, the second half or later on in 2021, I mean, those projects, if they come on, that's going to really kick up the implementation revenues, and likewise the volume, shouldn't it?
Well, we'll see about that. Yeah, I mean, we expect to come back, but we don't know how far the pushback, whether it'll come back in a short wave or a long wave.
Yeah.
So we'll just have to see how that flows back into us.
Yeah, and then just on the, I saw the net debt just ticked up to just south of sort of like 40 million, etc. I'm guessing that's going to come down towards the year as we get the as it starts opening up again, because you've got. Yeah, I mean,
we've historically generated cash second half rather than first half.
Yeah,
that's our general pattern. Obviously, we've still been losing ARR up until sort of this last 12 months when we've been flattish. So we've not been generating net cash from that perspective, and we've taken some upfront costs to concentrate on that margin.
Yeah,
that's driven the cash down a little bit at the first half, but we expect to grow from here. So we're comfortable with that situation.
And I mean, every sort of extra pound we put on ARR or the sales, presumably with the operating leverage and the fixed cost base, a large chunk of that should drop straight through to the bottom line, shouldn't it? Sort of like,
yeah. In the short term, it's very, very high levels because there isn't that additional cost, and we own manufacture all our products, so there's no bought-in license in reality. So in the short term, it's very highly leverageable. In the midterm, obviously, to grow the business, you need to put more into sales, more into professional services to deliver the higher volumes. So the pull through is a little bit different, maybe as high as 50% though.
Yeah, and so if it'll drop through to profit and also drop through to cash, presumably as well, won't it?
Yeah, exactly. Well, the cash cycle's pretty good because we invoice either annually or quarterly in advance.
Yeah, good. And then sort of like a longer term, sort of like, I know you've got a platform there, and you sort of like won, and also congrats on the. But actually, just before that, you just quickly fill us in on the BPaid contract. I forgot to cover that one. I forgot about that. Sorry.
We shouldn't have done. I mean, that's the other side of the strategic progress here. So, I mean, ultimately, our objectives here are to extend the reach of our mid-market focus into France, Germany, and the US, and then in each of our 5 territories to build out what is essentially an extra business spend management module We call it be paid, but it's an extra module that buyers would want to adopt.
Yeah.
What we've been able to do in the first 6 months of this year is to prove it in France and the UK that there's a proof point that that the service is valuable or valued by buyers for their supply chain. So we're absolutely delighted that we've been able to win those 2 contracts. Interestingly, the French one is on a buyer-funded model, and the British one is on a Proactis-funded model. So we've been able to win one of each part of it, and that shows the flexibility of the new product. So absolutely fantastic. Really happy that we've got those moving at last, and we want to do more. Of course, we do.
Yeah, and what is the pipeline for Be Paid like? Is there sort of customers now? They've got a sort of like a couple of reference sites.
It's referenceability first, referenceability and data, and then we push hard for pipeline. So you've got to go in with. So these guys are essentially early adopters. So we don't want to go too fast too soon. Yeah. But they're early adopters. We want to gather data. We want to look at the levers we can pull for take up, and then understand that a lot more before we take it as a productized product, out to the wider audience.
Yeah, and is there any way of actually using sort of like, I mean, you just talked about data, sort of big data analytics and AI on that, because you can, I mean, presumably you're covering literally millions of transactions each year across different suppliers, different customers, and therefore there should be some sort of like intelligence that you can some leverage out of it, I'd guess.
Oh, huge. I mean, we have massive data. 500 billion of spend goes between our buyers and their suppliers. So the extraction of that data and the utilization of it is going to be incredibly important. People are just touching at the tip of the iceberg at the minute.
Yeah.
So essentially, that and AI and learning is going to form part of our product development program as we move forward. The intelligent extraction of data and management of it. So yeah, absolutely forms part of our longer term plan. It has to do as well as ESG, which is going to be crucially important on supply chains.
Yeah, well, hey, I mean, you've been a software company, you're perfectly sort of suited to ESG, I guess.
It's absolutely massive in due course. It's going to become a requirement, not a best to have, but there's a window maybe in mid-market of the next 5 years where you can be a leader in that area.
Yeah, good. And then just on the sort of the net debt, I know there's the convertible debt. It's at very early days. We're talking well over a year. But is there any sort of like early thoughts on sort of? I know it's part of your business as usual activities in sort of like refinancing the convertible in. I think it comes up in July 22, so it's certainly not imminent.
Well, there's some of it comes at 22, but most of it is 23 and 24.
Oh, okay.
So there's a long time frame to it, and a lot can change in that time frame given what we're starting to achieve now. So we're leaving our options open. It's a business as usual negotiation for us at the time, and we'll move forward as the board decides.
Brilliant. Okay. Well, I think I just only for investors, just for the benefit. I mean, I know I've said this before, but I'll just reiterate it because it's absolutely crucial to the investment proposition. But at 47 per, you are just about one of the cheapest big data software companies and spend analytic companies I've ever come across, and you're trading on about 1.7 times sales and only just 7 times EBITDA, and the sector is on about 4 times and 4 times sales and on about 20 times EBITDA. So if you just did if you do start hitting the ball out of the park and hitting double-digit like for like growth, which is I think what the business is hoping to do in a sort of like a reasonable time frame, then you should be on, say, 4 times sales, which would be a share price of £1.50.
It's interesting. I appreciate those sentiments, and of course that's where Proactis was before it acquired Perfect Commerce in 2017. It was up at those kind of normalized levels, we would say, because that was performing with those metrics.
Yeah.
But it was interesting if you looked at the year-end results, apart from volume-related contracts and the HRAs that we had within us, volume-related contracts affected by COVID and the HRAs as one-time risks, we did 8% organic growth.
Yeah. I mean, I can understand that because
so for us, it's a question of the market recognizing the indicators, and it's still early for the market to do that. Of course, we respect the market's view, but essentially within us, we can see those indicators starting to come through, and therefore it's a question of time before we can demonstrate them.
Yeah, I mean, I think the top line has been artificially compressed or depressed. Not depressed. It's been artificially impacted by effectively the COVID side and the high risk accounts, hasn't it? If you didn't have that, They just say 8% last year. It'd probably be knocking the ball out the park and in the second half as well.
Well, there's certainly be progression. Absolutely, yeah, no, that's right. But it's a long-term game here, and we've got a chance to create a super company that's delivering exactly what you've described. And we can see the early indicators, but ultimately we have to show that over a longer term.
Yeah, and then just framing the next year, then, so the 2021, the calendar year. What should sort of like investors expect or hope for in terms of sort of like more contracts, more TCVs? And
absolutely, I mean, that's exactly what we need to deliver. So, I mean, the plan is to replicate what we do in the UK and the Netherlands in each of France, Germany, and the US. That involves selling more names and selling more TCV in each of those three territories. So, investors should expect us to see, as we come out of COVID and the world rights itself a little bit more, then we should start to see increasing TCV in each of those three areas, starting to equate to UK values over a 12 to 18-month time frame. And then also we should see BPAID coming through with more contracts. We won't announce every single deal that we do, but we will start to give indications of momentum reaching those kinds of levels.
Yeah. Well, I think with Andy Haldane, the chief economist of the Bank of England, only 2 weeks ago, saying the UK economy is a coiled spring, and likewise in the US is not far behind us. So I wish you very much all the best over the next 2 months, and look forward to speaking when the interims come out. I think it's the end of April, isn't it?
End of April, yeah.
Brilliant. Thanks, Tim.
All right, Paul.